Hello, everybody. Douglas Hart, Nexa Mortgage, had to put something together on the new penalized to higher credit scores loan level price adjustments. These are referred to as LLPAs. Once again, Fannie Mae, Freddie Mac loan level price adjustments. And you've probably been seeing these on the news, depending on which news channel you watch. But they're talking about how the rich is going to pay for the poor, and how the rich is being penalized now and the poor is getting a break at a better rate than the people with better credit. And I wanted to quantify this and break it down to everybody, clients, realtors. I've even seen a couple loan officers do videos that were highly misrepresentative of the actual changes. And then on top of that, maybe even where they come from and how often they happen. So I wanted to let people know this is kind of commonplace. And I'm going to do this by sharing my screen real quick. I'm going to first go over the price adjustments themselves. If you look at this chart and this chart only, you'll see, 700 through, 760 is getting some pretty heavy adjustments to the negative at 75 and 80% loan to value. Let me quantify loan to value. If you put a 20% down payment down, you're going to have an 87 basis point adjustment or 8.75% adjustment on a 720 credit score to a 739. Now, what does that mean? That means per $100,000, you're going to pay $875 in cost for the same rate. Now, if you go down here, it looks like they're getting a better rate than you. What's this? They have a lower credit score. They're getting a better rate. And until you get down to this guy, and he's getting half a point, but that's still better than this guy, And if you only look here, and of course that's cash out refi, this is the purchase chart where you're at a half a point hit, where this guy's getting a 3/4 point add. Why is this guy getting a better rate? But it doesn't stop there. You got to look a little further. All right. This is the actual chart. May 1st and beyond, this is the actual chart. So if you have a 720, you're getting penalized 1.25%, meaning $1,250 per 100,000. But this guy's at $2,750 per 100,000, $2,250 per 100,000. So it's not like you're paying more for the same rate that a lower credit score is paying. It's that they are penalizing them less than they have for many years. All right, that's what it comes down to, is they are penalizing them less than they have for many years. Now, we can talk about this. Why? I mean, how does that make sense to penalize the lesser credit for many years? Well, statistically, 660 and below, I don't know, maybe half of the nation has been penalized for many years, 3-4 points, to have a low credit score, which causes less home ownership in the Fannie Mae sector. Fannie Mae is not owned by the government. They're under conservatorship. They're, private institution, and the bottom line is they're based on profitability. So if you really look at, what is their purpose for all these LLPAs, I mean, you got to think it's about sustainability of home ownership, and they're being competitive in the market against FHA, VA, USDA, that kind of stuff, and those kind of options. FHA recently reduced their MIP aspect. Now, I mean, so we're not in a market to where it's just screwing the rich and helping the poor. This is a matter of maybe an overcorrection as to before. And then I do want to point out one other thing. This is actually a price chart that was postponed in 2014. And if you look, this was the price adjustments in 2014. It only went up to a 740 score. All right. And they were proposing 720 and up gets adjusted. They didn't have anything, and this was anything after April 1st, 2014. Now, of course, January 2014 was the creation of the CFPB, and they thought, yeah, it might be a bad idea to bring out these LLPAs right now. Market still hasn't fully recovered. People's 401ks hadn't recovered. Everybody was still trying to catch breath from the mortgage crisis. So it was just a bad time to start adjusting loan level price adjustments, but the spirit was still in mind to create a broader base of home ownership. You got to understand that, this is not monopoly. This is home ownership. And these institutions are meant to serve home ownership and the sustainability of home ownership, not monopoly. So if you look at this, and the other thing that I want to point out here, for the monopoly's sake, I want to point out a website. Oh, that's not it. Oh, I was going to point out a website that basically had the adjustments on it for secondary homes and investment properties. I mean, we've had those loan level price adjustments. Those have happened to the point of a 3-point adjustment, meaning $3,000 per 100,000 you're paying for the same rate. And those have happened also. Now, why do you think this is? You think inventory might have something to do with it? This might be a response somehow to like spread it out a little more to where we don't have more LAs and the homeownership problems, more San Franciscos and the homeownership problems. I mean, I think that this could be a response to that. Maybe, maybe not. Maybe it's a profitability aspect saying, hey, look, I'm only selling fidget spinners to 60% of the public. And if I can bring the price down to the other 40%, then I'll sell more fidget spinners. It could be that simple too. But no matter what, here's what it comes down to. You buy a house when the interest rates are at a certain level. Those rates go up and they go down. Well, guess what else does that? Loan level price adjustments. They happen and then they change. And then they happen again and then they change. And they've happened and changed for decades. Okay, so the end of the day, it's not, number one, a permanent thing. And number two, it's not an irregular thing. It happens all the time. It's happened underneath your nose for the last several years, constantly. So I just want you to know that it's normal place. Nothing is going to happen to a mortgage that you're already in. To my friends that have a home, your mortgage is not going to go up because of this. This is for people looking to refinance or buy a new home, and the new loan level price adjustments that go along with it. Now, last thing I want to point out, if you want to beat the system and play by the rules, look at the new purchase here. Look at the 95% column right here. Everything is an improvement in the 95% column. That means if you only put 5% down, you're going to get a better rate than you got yesterday, regardless of your credit score. And then on the third payment, put the other 15% on top of your payment and buy your principal down and get rid of the MI. Now you're playing by the rules and you're getting a better deal than you got yesterday. And you're beating the system. You're welcome for that. I hope this has been helpful. Obviously, feel free to ever reach out to me directly, DM me if you want to get a little more granular on this, and I'd be happy to help you with your scenario. Thanks.